An interest rate swap is a popular and highly liquid financial derivative instrument in which two parties agree to exchange interest rate cash flows, based on a specified notional amount from a fixed rate to a floating rate or from one floating rate to another. Interest rate swaps are commonly used for both hedging and speculating. Structure. In an interest rate swap, each counterparty agrees to pay either a fixed or floating rate denominated in a particular currency to the other counterparty. The fixed or floating rate is multiplied by a notional principal amount and an accrual factor given by the appropriate day count convention. When both legs are in the same currency, this notional amount is typically not exchanged between counterparties, but is used only for calculating the size of cash flows to be exchanged. When the legs are in different currencies, the respective notional amounts are typically exchanged at the start and the end of the swap. The most common interest rate swap is one where one counterparty A pays a fixed rate to counterparty B, while receiving a floating rate index to a reference rate. By market convention, the counterparty paying the fixed rate is called the payer, and the counterparty receiving the fixed rate is called the receiver. A pays fixed rate to B, B pays floating rate to A. Currently, A borrows from market at LIBOR plus 1.5%. B borrows from market at 8.5%. Consider the following swap in which Party A agrees to pay Party B periodic fixed interest rate payments of 8.65%, in exchange for periodic variable interest rate payments of LIBOR plus 70 bps in the same currency. Note that there is no exchange of the principal amounts and that the interest rates are on a notional principal amount. Also note that the interest payments are settled in net plus 8.65% equals 9.45% net. The fixed rate is referred to as the swap rate. At the point of initiation of the swap is priced so that it has a net present value of 0. If one party wants to pay 50 bps above the par swap rate, the other party has to pay approximately 50 bps over LIBOR to compensate for this. Types. Being OTC instruments, interest rate swaps can come in a huge number of varieties and can be structured to meet the specific needs of the counterparties. For example, the legs of the swap can be in the same currency or in different currencies. The notional of the swap could be amortized over time. The reset dates of the floating rate could be non-regular, etc. However, in the interbank market, just a few standardized types are traded. They are listed below. Each currency has its own standard market conventions regarding the frequency of payments, the day count conventions and the end-of-month rule. Fixed for floating rate swap, different currencies, Party P pays receives fixed interest in currency A to receive pay floating rate in currency B index to X on a notional N at an initial exchange rate of FX for a tenure of T years. For example, you pay fixed 5.32% on the USD notional 10 million quarterly to receive 3 million Japanese yen monthly on a JPY notional 1.2 billion for 3 years. For non-deliverable swaps, the USD equivalent of JPY interest will be paid received. No initial exchange of the notional amount occurs unless the FX fixing date and the swap start date fall in the future. Fixed for floating swaps in different currencies are used to convert a fixed-rate asset liability in one currency to a floating-rate asset liability in a different currency, or vice versa. For example, if a company has a fixed-rate $10 million loan at 5.3% paid monthly and a floating-rate investment of 1.2 billion Japanese yen that returns 1 million Japanese yen LIBOR plus 50 bps monthly, and wants to lock in the profit in USD as they expect the 1 million Japanese yen LIBOR to go down or USD JPY to go up, then they may enter into a fixed floating swap in different currency where the company pays floating 1 million Japanese yen LIBOR plus 50 bps and receives 5.6% fixed rate, locking in 30 bps profit against the interest rate and the FX exposure. Floating for floating rate swap, same currency, Party P pays receives floating interest in currency A index to X to receive pay floating rate in currency A index to Y on a notional N for a tenure of T years. For example, you pay 1 million Japanese yen LIBOR monthly to receive 1 million Japanese yen TIBOR monthly on a notional 1 billion Japanese yen for 3 years, or you pay 3 million European euros Ariba quarterly to receive 6 million European euros Ariba semi-annually. The second type of example, where the indexes are of the same type but with different tenors, are the most liquid and most traded same currency floating for floating swaps. Floating for floating rate swaps are used to hedge against or speculate on the spread between the two indexes widening or narrowing. For example, if a company has a floating rate loan at 1 million Japanese yen LIBOR and the company has an investment that returns 1 million Japanese yen TIBOR plus 30 bps, and currently the 1 million Japanese yen TIBOR equals 1 million Japanese yen LIBOR plus 10 bps. At the moment, this company has a net profit of 40 bps. If the company thinks 1 million Japanese yen TIBOR is going to come down or 1 million Japanese yen LIBOR is going to increase in the future and wants to insulate from this risk, they can enter into a float-float swap in same currency where they pay, say, JPY TIBOR plus 30 bps and receive JPY LIBOR plus 35 bps. With this, they have effectively locked in a 35 bps profit instead of running with the current 40 bps gain and index risk. The 5 bps difference comes from the swap cost, which includes the market expectations of the future rate difference between these two indices and the bid-offer spread, which is the swap commission for the swap dealer. Floating for floating rate swaps are also seen where both sides reference the same index, but on different payment dates, or use different business day conventions. This can be vital for asset liability management. An example would be swapping 3M LIBOR being paid with prior non-business day convention, quarterly on JAJO 30, into FMAN 28 modified following a florin, floating for floating rate swap, different currencies. Party P pays receives floating interest in currency A index to X to receive pay floating rate in currency B index to Y on a notional N at an initial exchange rate of FX for a tenure of T years. The notional is usually exchanged at the start and at the end of the swap. This is the most liquid type of swap with different currencies. For example, you pay floating $3 million LIBOR on the USD notional 10 million quarterly to receive 3 million Japanese yen TIBOR quarterly on a JPY notional 1.2 billion for 4 years. At the start you receive the notional in USD and pay the notional in JPY, and at the end you pay back the same USD notional and receive back the same JPY notional. To explain the use of this type of swap, consider a US company operating in Japan. To fund their Japanese growth, they need 10 billion Japanese yen. The easiest option for the company is to issue debt in Japan. As the company might be new in the Japanese market without a well-known reputation among the Japanese investors, this can be an expensive option. Added on top of this, the company might not have appropriate debt issuance program in Japan, and they might lack sophisticated treasury operation in Japan. To overcome the above problems, it can issue USD debt and convert to JPY in the FX market. Although this option solves the first problem, it introduces two new risks to the company: FX risk. If this USD JPY spot goes up at the maturity of the debt, then when the company converts the JPY to USD to pay back its matured debt, it receives less USD and suffers a loss. USD and JPY interest rate risk. If the JPY rates come down, the return on the investment in Japan might go down, and this introduces an interest rate risk component. The first exposure in the above can be hedged using long-dated FX forward contracts, but this introduces a new risk where the implied rate from the FX spot and the FX forward is a fixed rate, but the JPY investment returns a floating rate. Although there are several alternatives to hedge both the exposures effectively without introducing new risks, the easiest and the most cost-effective alternative would be to use a floating for floating swap in different currencies. In this, fixed for fixed rate swap, different currencies, Party P pays receives fixed interest in currency A to receive pay fixed rate in currency B for a term of T years. For example, you pay 1.6 Japanese yen on a JPY notional of 1.2 billion and receive $5 and 36 cents on the USD equivalent notional of 10 million at an initial exchange rate of USD JPY 120. Other variations. A number of other variations are possible, although far less common. Mostly tweaks are made to ensure that a bond is hedged perfectly, so that all the interest payments received are exactly offset by the swap. This can lead to swaps where principal is paid on one or more legs, rather than just interest, or where the balance of the swap is automatically adjusted to match that of a prepaying bond. Brazilian swap uses. Interest rate swaps are used to hedge against or speculate on changes in interest rates. Speculation. Interest rate swaps are also used speculatively by hedge funds or other investors who expect a change in interest rates or the relationships between them. Traditionally, fixed income investors who expected rates to fall would purchase cash bonds, whose value increased as rates fell. Today, investors with a similar view could enter a floating for fixed interest rate swap. As rates fall, investors would pay a lower floating rate in exchange for the same fixed rate. Interest rate swaps are also very popular due to the arbitrage opportunities they provide. Due to varying levels of creditworthiness in companies, there is often a positive quality spread differential which allows both parties to benefit from an interest rate swap. The interest rate swap market in USD is closely linked to the euro-dollar futures market which trades among others at the Chicago Mercantile Exchange. British local authorities. In June 1988 the Audit Commission was tipped off by someone working on the swaps desk of Goldman Sachs that the London Borough of Hammersmith and Fulham had a massive exposure to interest rate swaps. When the Commission contacted the Council, the chief executive told them not to worry as everybody knows that interest rates are going to fall. The Treasurer thought the interest rate swaps were a nice little earner. The controller of the Commission, Howard Davis, realized that the Council had put all of its positions on interest rates going down. He sent a team in to investigate. By January 1989 the Commission obtained legal opinions from two Queen's Counsel. Although they did not agree, the Commission preferred the opinion which made it ultra-vires for councils to engage in interest rate swaps. Moreover, interest rates had gone up from 8% to 15%. The auditor and the Commission then went to court and had the contracts declared illegal. The 5 banks involved lost millions of pounds. Many other local authorities had been engaging in interest rate swaps in the 1980s, although Hammersmith was unusual in betting all one way. This left a train of cases, where generally the banks lost their claims for compound interest on debts to councils, finalised in Westdeutsche Landesbank Girozentrale v Islington London Borough Council. Valuation and pricing. The valuation of vanilla swaps was often done using the so-called textbook formulas using a unique curve in each currency. Some early literature described some incoherence introduced by that approach and multiple banks were using different techniques to reduce them. It became even more apparent with the 2007 Euro 2012 global financial crisis that the approach was not appropriate. The now standard pricing framework is the multi-curves framework. The present value of a plain vanilla swap can be computed by determining the present value of the fixed leg and the floating leg. The value of the fixed leg is given by the present value of the fixed coupon payments known at the start of the swap, that is, where C is the swap rate, N is the number of fixed payments, N is the notional amount, is the accrual factor according to the day count convention for the fixed rate period and is the discount factor for the payment time. The value of the floating leg is given by the present value of the floating coupon payments determined at the agreed dates of each payment. However, at the start of the swap, only the actual payment rates of the fixed leg are known in the future, whereas the forward rates are unknown. The forward rate for each floating payment date is calculated using the forward curves. The forward rate for the period with accrual factor is given by whereas the market index, such as USD LIBOR, and is the discount factor associated to the relevant forward curve. The value of the floating leg is given by the following. Where M is the number of floating payments, is the accrual factor according to the floating leg day count convention. The fixed rate offered in the swap is the rate which values the fixed rate's payments at the same PV as the variable rate payments using today's forward rates, that is. Therefore, at the time the contract is entered into, there is no advantage to either party, that is. Thus, the swap requires no upfront payment from either party. During the life of the swap the same valuation technique is used, but since, over time, both the discounting factors and the forward rates change, the PV of the swap will deviate from its initial value. Therefore, the swap will be an asset to one party and a liability to the other. The way these changes in value are reported is the subject of IAS 39 for jurisdictions following IFRS, and FAS 133 for U.S. GAAP. Swaps are marked to market by debt security traders to visualize their inventory at a certain time. Risks: interest rate swaps expose users to interest rate risk and credit risk. Market risk: a typical swap consists of two legs, one fixed, the other floating. The risks of these two components will naturally differ. Newcomers to market finance may think that the riskier component is the floating leg, since the underlying interest rate floats, and hence, is unknown. This first impression is wrong. The risky component is in fact the fixed leg and it is very easy to see why this is so. Comment: the above comment is not entirely accurate. Normally people will assume a hypothetical notional exchange at the end. After this hypothetical assumption, the swap can be understood as a floating rate bond versus a fixed rate bond. The risks on the floating bond side are small compared to the risks from the fixed rate bond side. However, without this hypothetical notional exchange at the end, purely the floating cash flow from the coupon payments will have higher risks than the cash flow from the fixed coupon payments. Both understanding have their merit, and fully understand these two views are important to see the risks, particularly for floating swaps. The discussion of pricing interest rate swaps illustrated an important point. Regardless of what happens to future LIBOR rates, the value of a rolling deposit or FRN always equals the notional amount N at the reset dates. Between the reset dates this value may be different from N, but the discrepancy cannot be very large since the I will be 3 or 6 months. Interest rate fluctuations have minimal effect on the values of fixed instruments with such maturities. In other words, the value of the floating leg changes very little during the life of a swap. On the other hand, the fixed leg of a swap is equivalent to a coupon bond, and fluctuations of the swap rate may have major effects on the value of the future fixed payments. Credit risk on the swap comes into play if the swap is in the money or not. If one of the parties is in the money, then that party faces credit risk of possible default by another party. However, when the swap is negotiated through an intermediary financial institution, usually the intermediary assumes the default risk in exchange for a fixed percentage of the transaction. In an intermediated swap, the two parties are not typically even aware of the identity of the second party to the transaction, making a quantification of the other party's credit risk not only irrelevant, but impossible. Market size: the Bank for International Settlements reports that interest rate swaps are the largest component of the global OTC derivative market. The notional amount outstanding as of June 2009 in OTC interest rate swaps was $342 trillion, up from $310 trillion in December 2007. The gross market value was $13.9 trillion in June 2009, up from $6.2 trillion in December 2007. Interest rate swaps can now be traded as an index through the FTSE/MT/IRS index. See also, swap rate, interest rate cap and floor, equity swap, total return swap, inflation derivative, euro-dollar, constant maturity swap, FTSE/MT/IRS index. References: interest rate swap. Glossary. ISDA, interest rate swap by Fiona McLaughlin, The Wolfram Demonstrations Project. Interest Rate Instruments and Market Conventions Guide, Quantitative Research, Open Gamma, 2012. Duncan Campbell Smith, Follow the Money, The Audit Commission, Public Money, and the Management of Public Services 1983-2008, Allen Lane, 2008, Chapter 6 PASM. 1996, UKHL 12, 1996, AC 669, Understanding Interest Rate Swap Math and Pricing. California Debt and Investment Advisory Commission. January 2007. Retrieved September 27, 2007. http, Chicago.org Publications Index CFM, Pricing and Hedging Swaps, Mirren P. and Swanor P., Euromoney Books 1991, Early Literature on the Incoherence of the One-Curve Pricing Approach. Interest Rate Parity, Money Market Basis Swaps and Cross-Currency Basis Swaps, Tuckman B. and Porfirio P., Fixed Income Liquid Markets Research, Lehman Brothers, 2003. Cross-Currency Swap Valuation, Bowie and Cost W. and Schmidt W., Working Paper 2, HFB, Business School of Finance and Management, 2004. SSRN preprint. The Irony in the Derivatives Discounting, Henry M., Wilmot Magazine, ppA 92 €98, July 2007. SSRN preprint. Multi-Curves Framework, a Multi-Quality Model of Interest Rates, Kojima M., Tanaka K., and Wong T., Quantitative Finance, pages 133 to 145, 2009. Two Curves, One Price, Pricing and Hedging Interest Rate Derivatives Decoupling Forwarding and Discounting Yield Curves, Bianchetti M., Risk Magazine, August 2010. SSRN preprint. The Irony in the Derivatives Discounting Part 2, The Crisis, Henry M., Wilmot Journal, Volume 2, ppA 301 €316, 2010. SSRN preprint. External links, Understanding Derivatives, Markets and Infrastructure Federal Reserve Bank of Chicago, Financial Markets Group, Bank for International Settlements, Semi-Annual OTC Derivative Statistics, Investopedia, Spreadlock, an Interest Rate Swap Future, Basic Fixed Income Derivative Hedging, article on financial-edu.com. Hussman Funds, Freight Trains and Steep Curves, Interest Rate Swap Calculator, Historical USD Swap Rates, All About Money Rates in the World, Real Estate Interest Rates, Worldwide Interest Rate S.com.